Hello friends, welcome to my YouTube channel. Myself Shayan Banerjee. Last day we discussed about portfolio return and portfolio standard deviation. We learned how to compute portfolio risk and portfolio return, right? Today we'll see what is the advantage of creating portfolio as regards reduction of risk, right? So I would like to reiterate that portfolio is nothing but combination of different assets in one basket, like stocks, bonds, money market instruments, right? And once again, if we invest in two securities rather than one security, that also becomes a portfolio, right? So what is the advantage of creating portfolio? We need to understand that. I can cite one example by which we can gauge the advantage of portfolio creation as regards reduction of risk. Suppose you have been given a matchbox sticks and you are told to break that matchbox stick. It will be broken easily, but you are given a bunch of matchbox sticks and you are told to break that bunch of matchbox sticks. It will not be broken. So that is the concept of diversification of risk. When portfolio is created, the diversification of risk happens, right? I can see or rather show you with an example, hypothetical example, which is written over the board. I can show you what are the advantages of creating portfolio, right? See, year is given, year 2020 and 21. Two securities are given, return of two securities are given, X and Y, and in the year 2020 X is given 20% return, and in the year 2021 X is giving 0% return, whereas in the year 2020 Y is giving 0% return, and in the year 2021 Y is giving 20% return, right? So if we invest in one security X and Y, X or Y rather, we need to understand what is the risk and return profile of individual asset. So to determine that, we need to compute the risk and return of individual asset X and Y, right? We can compute so we'll compute that average risk or mean average return and mean return and standard deviation of each security over there. So X bar or expectation of X, we can write 20 plus 0 divided by 2. So that will be 10%. So percent. And similarly, the mean return of Y or expected return of Y will be Y bar or expectation of Y will be 0 plus 20 divided by 2. So both assets securities are giving same return 10% each, right? Now we have to compute the standard deviation to determine the risk of individual security, right? So SD of X, we write sigma X is equal to root over 20 minus 10 whole square plus 0 minus 10 whole square divided by 2. So what will be the result? It will be 100, root over 100. So the risk will be 10%. Similarly, SD of Y, that means sigma Y, will be 0 minus 10 whole square plus 20 minus 10 whole square divided by 2. Again that will be 200 divided by 2, that is root 100 is equal to 10%, right? So we can see each of these securities are giving same return 10%, and each of these security are equally risky because both the standard deviation of both securities are 10%, right? So these are risky security. Now the question comes, if we form one portfolio of two assets, that is X and Y, by certain percentage, what will be the advantage as regards reduction of risk? We create a portfolio by giving 50% weightage of X and 50% weightage of Y, right? So in that case, in the year 2020, the portfolio return will be, the return of the portfolio will be in 2020 20%, that means return of 20 of X in the year 2020, 20% into 0.5 plus 0%, means in 2020 Y is giving 0%, 0 into 0.5, so that means 10%, right? Return of portfolio, if we form one portfolio by combining asset X and Y in the equal proportion, then portfolio return will be 10% in the year 2020. What will be the portfolio return in the year 2021? That will be X is giving 0% return into 0.5 plus Y is giving 20% return into 0.5. So that also becomes 10%. So you can understand from these figures that there is no variation of return. So in the year 2020 it also given 10%, and in the year 2021 it is also giving 10%. So there is no variation of return. So standard deviation of the portfolio will be 0. We can prove this by the formula of standard deviation. So we need to arrive at the portfolio standard deviation, then we write sigma p. So portfolio standard deviation will be what? The formula goes, I am not writing the formula, I am directly putting the figures over the formula. So that means standard deviation means variance of security Y, 10 square, into weightage of security X, that means 0.5 square, plus variance of security Y, that means 10 square again, into weightage of security Y, 0.5 square, plus 2 into sigma Y, sigma X means 10, sigma Y means 10, and W1 means, Wx means 0.5, and W2 means 0.5, and Rxy. We need to compute Rxy for that. What is Rxy? Correlation coefficient. How it is calculated? Correlation coefficient Rxy. Again, putting the direct figures into the formula. That means 20 minus 10 into 0 minus 10 plus 0 minus, that is 0 minus 10 plus into 20 minus 10 divided by 2 divided by sigma X means 10 into sigma Y means 10. So it will be 20 minus 10 means 10, minus 10 means minus 100, that will also be minus 100. So divided by 2 divided by 100. So minus 100 divided by 100, that means minus 1. So value of correlation coefficient is minus 1. Now we will compute the portfolio standard deviation. So 10 square into 0.5 square, that is 25 plus, that will also be 25 plus 2 into 10 into 10 into 0.5 into 0.5 into minus 1. So that is minus 50. So 50 minus 50 is equal to 0%. So we can prove that the portfolio standard deviation is 0. That means there is no variation of return in case of creating portfolio with the help of two securities X and Y. Right? So that is the advantage of portfolio creation, and we can understand by the example that portfolio, if the correlation coefficient is negative or 0, we can create portfolio with reduced risk, right?